Now, Veriv Africa's 2025 forecast predicts significant economic challenges for Nigeria. The Naira may depreciate to 2,000 Naira per dollar, that's in worst case scenario, or stabilize at 1,790 Naira per dollar, and that is the best case scenario. Now, the GDP growth rate may reach 3.6% under favorable conditions or drop to 2.5% in a worst-case scenario. Inflation is expected to remain high at 31%, with fuel prices potentially exceeding 1,100 Naira per litre. Will Nigeria's economy bounce back in 2025, or will these challenges persist? Now, we have two guests with us this evening. We have, first of all, Basil Abia, his co-founder, Veriv Africa from Abuja. And we also have Gospel Obele, his chief economist, Streetnomics Ltd in Lagos. Good evening, gentlemen, and thank you for joining us at this time.
Good evening, Dashin. It's an absolute pleasure to be here.
All right, I'm told that Gospel will be joining us in a bit. But then let's begin with you, Basil. Now, in 2025, you know, in your outlook for 2025, you've projected the Naira could reach as high as 2,000 Naira per dollar, right? That's in a worst case scenario. Now, could you talk us or walk us through the determinants that could drive this kind of depreciation?
Yeah. Thank you, Dasha. So first assumption for our worst case scenario, like always, the forecast, we work on three different scenarios. The worst case scenario, the base case scenario. The base case scenario, of course, is business as usual if indicators and particular determinants of indicators do not change too much. And then, of course, we have the best case scenario if we're able to have a government that adheres to some of our policy recommendations, and also if we're fortuitous in terms of exogenous shocks. But with the determinant for the worst case scenario, that's the Naira being 1,930 to 2,000 Naira per dollar in the exchange rate market, especially in the parallel market. The first determinant is a Donald Trump presidency. He has, of course, as you do know, won the US presidential election, and he's going to be sworn in January 6, 2025. One of the key things, I would say, antecedents for a Donald Trump presidency, and we saw that when he did his first tenure, was the need to continue to do further exploration for oil and gas, to increase and ramp up oil production, because he doesn't like the gas prices, using colloquial American English parlance. He thinks that the gas prices are super high and he wants to get them low. And of course, as you know, common sense thinking from the American economic perspective is to be able to ramp up production. And they have the capacity to do so. They have a lot of, I would say, untapped oil and gas assets, especially through a very controversial process, fracking. So the shale oil exploitation, further fracking, especially in areas that are dominated by Native American autonomous communities, where there have almost always been problems in that regard with exploitation, because for some reason, impugning on those spaces is, you know, again, aside from the human rights violation, is also the environmental bureaucracy that has happened with the EPA. EPA basically is the European Protection Agency, and MDA in America, where most times they slow down on oil and gas expansion, especially with exploitation. So Donald Trump's concern is that he wants to be able to slow down or curtail all of these bureaucracies so that America can increase oil and gas production. And if there's an increase in oil and gas production by, of course, the American state, or the United States of America, in you know, a collaboration with, for instance, OPEC also increasing supply due to geopolitical tensions in the Middle East, what we're going to have is definitely an anticipated $70 per barrel or lower in the global oil prices. And if, again, part of our determinants for our assumption is that anything $70 per barrel or lower is a huge part of, you know, FX earnings reducing, because as you do know, 70% of our export earnings come from oil and gas exports. So the prices, oil prices dipping down definitely affects that. And with oil prices dipping down, we also are going to see a lot of pressure on the exchange rate market. And when that happens, with the potential budget for 47 trillion naira, that means that money supply growth will be increased. So the second determinant of a 2,000 naira per dollar assumption in terms of our forecast is if money supply growth grows by 5% or higher next year. And with the confirmation of the budget proposal, I have no doubt that our assumption for a money supply growth of 5% is accurate. So a combination of oil prices reducing going lower than $70 per barrel, and money supply growth due to the very high budget of 47 trillion naira, money supply growth increasing by 5% next year, is the core determinant of why we think that the naira is going to
all right, Basil.
to a dollar.
Now, Basil, if you can hear me, we'll definitely come back to speak more on oil and all that. But then in your report, you forecast a GDP growth rate of 3.6%. That's also in the best case scenario. Now, given that the country's economic struggles, including inflation and also unemployment, how optimistic are you about achieving this particular growth rate?
Optimistic, okay, let me take a bite at this. So the optimism isn't there from my own end, personally, but from the company, again, because we have a number of economists and economic analysts, especially policy analysts, from energy perspective, from mining perspective. There's almost a consensus that while it is good to hold on to the optimism of a 3.65% GDP real growth rate next year, the only chance, again, I have to highlight, the only chance of us reaching 3.6% is if we have a mix of luck in oil prices. Remember, I'll have to walk you through our assumptions again. Our assumptions for best case scenario, 3.65% GDP real growth rate. First and foremost is that the oil sells for $90 per barrel or more. So if we're able to get the international oil markets to give us consistently from January to December 2025, $90 per barrel or more, then we have a great chance. The second great chance is if we're able to keep money supply growth at minuscule levels. So highest it should grow should be at 1.25% or lower. So if money supply growth rate increases by just around 1%, then we're good. There's a high chance we're going to reach there because, of course, we know the dynamic of that of inflation. Now, thirdly, and most importantly, if a number of our policy recommendations are adhered to, so that means rethinking money supply, monetary policy rates, for instance. While you can still increase monetary policy rate, why don't you be a bit innovative with using the carrot and stick method? And what I mean by carrot and stick method is a third cash reservation ratio monetary policy rate strategy, whereby you look at banks and you tear them based on their non-performing loans performances and their loan to deposit ratios. Now, what I mean by loan to deposit ratio is the amount of monies that the banks are giving to their customers and their clients in the form of debt compared to the amount of monies that they have, that they are holding of the clients and the customers. And on average in Nigeria, we have a 59% loan to deposit ratio in our financial system, which is significantly lower than our African peers. South Africa, for instance, they have a ratio of about 105% in their loan to deposit ratio, which means they give more loans than the old deposits of their customers and their clients in their financial system. That means that we have a very illiquid real sector. Another stat to back our illiquidity assumption for the Nigerian financial markets is that if you look at our 100, by the way, we have our banking sector has an asset size of about 100 trillion naira or more. And out of that 100 trillion naira asset base that the Nigerian banking sector has, over 36% of it are in loans. And in that 36% loan base of the banking assets that we have in the country, 61% of it are short-term loans. So while in our real sector, the banking sector doesn't give our real sector a lot of loans, when they do give them, they give them very short-term loans. And you cannot do development that way. So what we're trying to say is that a way to incentivize more longer-term long tenure loans by our financial sector is if the Central Bank of Nigeria starts to apply or goes back to that third CRR system, where they look at banks and banks that are doing very well in terms of loan to deposit ratio and have very low NPL rates. When they have those low NPL rates, you tear them as tier A. When you tear them as tier A, you reduce their CRR stipulations. Cash reservation basically is the amount of cash that you're going to be able to enable, as a central bank, enable these financial institutions, especially the banks, to have. And the more cash you give them, these banks are able to now use it to do more loans, give more loans to real sector players who are in deep need of Naira liquidity.
While you're talking about central bank, now you did mention, or your company did mention, an inflation rate of 31%. That's come 2025. Now,
base case scenario.
Yeah,
base case scenario.
Yeah, okay. So now, how can the central bank, of Nigeria balance, controlling inflation and also, supporting economic growth?
That's exactly what I said. The example I was trying to say, basically what I'm saying is central bank has to rethink its monetary policy rate and go back to the strategy of tearing cash reservation ratio. They have two tools with which they control inflation, the central bank. First tool is their monetary policy rate. That's the interest rate determination that they do whenever they have their monetary policy committee. As you know, of course, monetary policy rate right now is about 27.5%. Now, they're about to have their MPC again, which they will probably hike it again by another 50 basis points. What I mean by basis points is another 0.5% to be added to the MPR. The second tool that the central bank has to control inflation is the cash reservation ratio that they use. Basically, the allowance that they give banks to have Naira liquidity to be able to give, of course, to be able to give their further loans. So what I'm basically saying and what we're arguing at Veriv Africa is that we should go back to that policy where central bank tears the banks into three tiers: tier A, tier B, tier C. Tier A will be for banks that are better performing when it comes to their loan to deposit ratio, which basically means they are, in spite of the really tough structural macroeconomic conditions, they are still willing to give loans to the real sector. So you incentivize them further by giving them more allowance to give more loans. But you have to also look at their non-performing loans base. And if those banks have very healthy non-performing loans, it means that the banks have very good or great credit management systems. So banks with great credit management systems should be incentivized and not punished. Why should we punish all the banks at the same level when there are some banks that are doing better than the rest? So the banks that are doing very well in credit management, give them more allowance to give more loans. Then you tear them. The best ones, the best performing ones are in tier A. The better performing ones are in tier B. The worst performing ones are in tier C. So you have the tier C banks who are punished. Basically, their CRR increases. If the CRR is 33%, they should be able to charge, the bank should, central banks should stipulate 40% CRR to banks that have very poor NPL rates and very poor loan to deposit ratio. So the banks in tier B levels should be able to be punished adequately. And then, of course, the banks in tier A should be incentivized to loan more. That way, you are able to see more credit access to real sector, and the real sector will be able to have more finance. Because again, if you look at if you read the reports from the Manufacturing Association of Nigeria, if you also look at manufacturing performance indicators from the Central Bank of Nigeria, as well as the Nigeria Economic Summit Group, who have all carried out reports in the last 1 month, you will see that the number one recurring factor that the manufacturers are highlighting always is the low or very skeletal access to credit, Naira-based liquidity from the financial institutions. And it's simply because of structures like the CRR and the very high MPR. So if you do this type of segmentation, it's much better. Real sector players can now approach the banks that have lower CRRs and access Naira liquidity financing, short-term, medium-term, and long-term financing. And we will see much more liquidity coming from the real sector, because it's liquidity from the real sector that will turbocharge the economy. And we will be able to see significant reduction in inflation. And our aggregate inflation will be around 31% or even lower. That's what we're anticipating at best case scenario if central bank adheres to some of these recommendations. And if the federal government of Nigeria as well carry out their own heavyweight Constitutionally, their major heavyweight is the protection of lives and property, safeguarding the territorial integrity of Nigeria. And we're not doing that. We're not seeing that from the federal government. In fact, we have a new terror group, transnational terror group, that are now active in the Northwest. The Lukawara group from Niger. You know, they're adding to our insecurity threshold, our insecurity burden. That means that farmers in the Northwest for the next farming season will find it even more difficult to be able to farm. It is no longer news that farmers in the North Central, as you are aware, Dashan, and in the Northeast have been paying tributes to terror groups, to bandits, to criminal groups to be able to access their farms to farm. This has been a case for the last 5-6 years. That price transmission also even affects the farmers because they don't even want to go to farm again when they know that they're paying steep prices in tributes just to be able to access farming. That is, of course, affecting the cultivated area acreage that we have in the country. And the lower the cultivated area acreage, the lower productivity, the lower productive yields per crops.
Well, Basil, it's a good thing that you continuously use the word, hopefully and if. But then, we all know, what's happening when it comes to, the debt burden. Nigeria's debt burden, continues to rise. Is there a possibility for government to be able to manage its fiscal policies without adding to the debt crisis while also, stimulating economic growth?
I think the new tax reform bills by the federal government, if, of course, some of the tenuous issues in those bills are sorted out by the National Assembly, I'm convinced that the new tax reform bills would be able to ramp up domestic revenue mobilization. So to answer your question, Dasha, yes, there's a way to manage fiscal policy in a way that turbocharges the economy, ensures there's more liquidity coming, both from the public sector and the private sector, while also reducing our debt burden, ensuring that we are managing our debt in a healthy way so that we reduce our debt to GDP and debt to revenue levels. As you do know, debt to revenue is now down to 74%, if I'm not mistaken. It used to be 95% last year, and it was even far worse 2 years ago that the president, Muhammadu Buhari presidency. But now, to further answer your question, once we are able to see increase in domestic revenue mobilization, especially when we increase our VAT revenue, we increase our income tax revenue, and CIT, there's a chance that we might not even be able to increase our CIT because one of the stipulations or one of the propositions in one of the 4 tax reform bills provided, of course, and crafted by the Presidential Tax Advisory Committee that is obviously trying to work on a way to revamp our tax policy. One of the stipulations or one of the propositions is that we reduce CIT from 30+% to over 25% to stimulate more foreign direct investment. That basically means that we will not increase tax revenues across board when it comes to company income tax, but we are able to see those supplemented with increases in VAT rates because there's a potential increase in VAT rates and then significant increases in progressive taxation when it comes to income taxes for our workers or our worker base. So if we're able to ramp that up, we're able to ramp up automation of tax clearance, automation of tax collection. We're making it easier for companies and individuals to clear their taxes with the FIRS and the respective IRSs of the respective states and the FCT. Then sure, we'll be able to see increase in domestic revenues that will supplement the revenues that we're going to get from our oil exports and non-oil exports. As you do know, of course, in the last 1 year, we've seen significant increase in non-oil exports. We hope that that continues next year, so that that is supplemented by increase in domestic revenues. And if we see increase in domestic revenues, there will be lower need to continue to enter the international debt market or even collect debt from development financial institutions like the debt that we're about to collect from the World Bank in the form of budget support.
Okay, Basil. Now, we all know that, Nigeria is vulnerable to global economic shocks as well, particularly in areas such as, oil price fluctuations, the geopolitical tensions in, the Middle East, and also international trade disruptions. Now, how can we reduce our reliance on external factors, especially with the increasing global economic uncertainty?
We proposed more economic diversification. While the economy is technically diversified because we have a lot more productive actors and productive sectors that are basically pushing and popping up the aggregate of the economy, we don't have in the right sense, a fully diversified economy where we are not at risk or vulnerable to one commodity price. So basically, we are still at the receiving end and we're still susceptible to, say, for instance, geopolitical tensions that will affect global oil prices and make the global oil prices lower. So because we're earning 70% of our earnings come from oil and gas, petroleum industry, we're still susceptible. So how do you reduce that susceptibility? How do you reduce that vulnerability, economic vulnerability? You have to diversify. That means we have to increase our mining to GDP contributions. We have to increase our agriculture to GDP contributions. Mining to GDP contribution is lower than 1%. That's the data from the National Bureau of Statistics. Another data, again, to be able to highlight from the Food and Agriculture Organization of the United Nations is that 25.6% of the contributions to the GDP come from agriculture. We need to be able to increase that number. When you increase that number, when you increase that of mining, when you increase that of the creative economy, when you increase that of manufacturing and services, you basically increase contributions to our revenues as a country, and you reduce that vulnerability to global oil prices. So in all honesty, the only thing I can say in an answer to you and the audience of News Central is that policymakers, government actors, including private sector actors as well, we have to double down on the word diversification. So we have to diversify increasingly and aggressively in 2025. That's the only way it would reduce our susceptibility to geopolitical tensions affecting global oil prices and exogenous shocks from
How about improving, the business climate and also to attract more foreign direct investment, into critical sectors? Because we know it's no news that, Nigeria's attractiveness to foreign investors is on the decline.
Yeah, that is definitely, I would still call that a pipeline of diversification, because there's no way you're trying to diversify the economy and you don't target foreign direct investment to help with the productive units. I will give you an example, for instance. In the agricultural sector, because we need to increase productivity, because we need to increase the contribution of the agricultural sector to GDP, we need foreign players to also come and be investors in the space. Because there's an instructive stat here to look at. 95% of agricultural activity in Nigeria is non-mechanized. Only 5% is mechanized. We cannot, by magic, prop up 5 or 10 mega agricultural food producers in the country who are domestic. It's impossible to do that in 1 year. But what you can do is definitely get macro or mega food producers, food growers from Brazil, from Belgium, from Netherlands, from the US, incentivize them to come and set up shops in our farmlands. But how do you do that when we have the insecurity situation of the country? So yes, we have to make sure the business environment is friendlier. We have to do that by securing our territories, by making sure that our localities, since, of course, again, 90% of food production activity is carried out in the rural areas. So in rural Nigeria takes the burden of food production. And if you want those big players from Brazil, from Canada, from the US, from Belgium, and from Netherlands to come and invest and set up shops, processing plants, and big high-tech precision agricultural farms, demonstration farms in rural areas, then you have to be able to secure them. You also have to make sure that the tax code is unified and segmented, and also in a way simplified. So once the tax code is simplified, which we're hoping to see from tax reforms bills, once the local governments, the state governments, and federal government take on that particular responsibility of securing lives and properties, and then also ensure that bureaucracy is reduced, red tape is reduced, so that the business environment is easier and friendlier, then we will see FDI in the form of, so this, my example of agricultural activity, we will see more FDI presence in the country. And with that FDI presence, we will reduce our vulnerability to exogenous shocks.
Okay. All right, now just before we let you go, Basil, in the context of your 2025 forecast, what is your last word or your long-term vision for Nigeria's economy? What should the country prioritize, to ensure sustainable development and avoid recurring economic volatility?
One word: governance. We need both subnationals and the federal government of Nigeria to govern, to actually govern. What do I mean by that? Delivering public goods, to the people as at when due, being transparent and accountable, operating lean governments, ensuring that they take on the constitutional responsibility of securing lives and property. When you do just that, the business environment, the productive environment becomes easier, healthier, and better. And these environments prop up more productivity. And with more productivity, we start to report growth rates of about 6% or more. And we've had an experience with that before. There was a time we did 15% GDP real growth rate in a year. The year 2002 under President Olusegun Obasanjo. And we consistently did 7% and above throughout his tenure. We got lower to 5%, 6%, hovering between 5%, 6% under President Yaradua, and then, of course, under Goodluck Jonathan, between 5% and 6% as well. But what I'm basically trying to say is that we have had an experience as a country in the last 30 years of registering growth rates of higher than 5%. And I think that is the level that Nigeria should be able to aspire to. But you cannot record 5% real annual GDP growth rates every year without governance taking their own responsibility and doing the heavy lifting. So they have to govern. All of these politics and intrigues, it doesn't matter in the long term. What matters is how much real economic growth, how much productivity you can be able to engineer as a government. And we're not seeing that. We're not seeing that in the last 8 years. So the work that Veriv Africa is leaving for policymakers, friends, and families of these governance actors is to govern. Once you're able to govern, private sector is going to come to where there is law and order. That's just the truth of capitalist-led growth. And if you want capitalist-led growth that increases our growth rates, that reduces unemployment, that increases the aggregate earnings, that reduces inflation, and we start to see a lot more productivity happening in the country, then the only way to do that is that our subnationals, that's our state governments and our federal government and our local government as well, now that they have financial autonomy, technically, they have to govern, and govern well.
Okay. Well, thank you so much, Basil Abia, co-founder Veriv Africa, for joining us and speaking to us on this.
Thank you so much, Dashan. It's an absolute pleasure to be here.